Hey, what is up guys? It's your boy Nick, and in my last video, I promised you guys a total stock market portfolio update if we got over 300 likes before my next upload. And honestly, all I can say is wow, you guys absolutely killed it, getting over 1,000 likes in the first week alone. So I truly just wanted to say thank you, and to demolish that like button once again for the transparency in this video. Now I'm about to be revealing my entire stock market investing account, which is split up between my Questrade TFSA and then my Wealthsimple Trade TFSA over here in Canada. But before getting into this video, there are two things that I want you guys to keep in mind. Now, as a 24-year-old, I've only been investing in the market for just less than 2 years now, where I started in about July of 2018 and then started investing a little bit more heavily in the beginning of 2019. Where over this entire time frame, the S&P 500 has been up and down, but overall, in terms of capital gains, it's essentially been flat. And as a result of me buying my first home in December of 2019, having a huge down payment, I really haven't had a whole lot of cash left over to buy on the dips when the stock market crashed. And so as a result, I am revealing this portfolio in a position of weakness. But this is simply an illustration of the reality of long-term investing. I'm truly not concerned about the short-term performance of my portfolio because I don't plan on taking this money out for the next 40 years. And as I'll explain throughout this video, I do plan on adding to many of these positions that are down at the moment because this is in line with the value investing approach that I preach on this channel. So with that being said, make sure to hit the like button down below and don't forget to subscribe for more weekly investing videos just like this, and let's get into my portfolio. Alrighty guys, so first jumping into my Questrade TFSA account, which is a tax-free savings account over here in Canada, and this has a current value of just over $30,800. So as you can see, in terms of the portfolio allocations, I have about 80% in stocks, 10% in ETFs, and then the remaining 10% in cash. Now let's start by addressing the elephant in the room, and that is the unrealized losses that I have in my account right now of $2,300 Canadian and then $1,700 US that I'm down. And as you'll find in my portfolio, much of these losses is only due to about 2 or 3 stocks that really haven't been performing that well throughout the stock market crash. So it really doesn't take much to make a portfolio go from the positive to the negative very quickly. But anyways, jumping into the first stock in my portfolio, that is the Bank of Nova Scotia with ticker symbol BNS.TO. Now in this stock, I own 65 shares at an average cost per share of $69.84, bringing my total position cost to just over 4,500 Canadian. However, the current market price is $54, so I am down just over 20%, but I do have another position in this stock in the second portfolio that I will be getting into at the end of this video. Now, as you all know, I'm very bullish on Canadian bank stocks, and Bank of Nova Scotia is no exception to this. However, what we've seen recently is that banks are going to be taking major losses on their balance sheet because of the current market issues and so many other businesses going out of business. In fact, the company's CEO, Brian Porter, stated on April 7th that the company expects somewhat elevated loan losses over the next few quarters, but is still certainly committed to paying that dividend. And just to reaffirm the company's strong financial position, the CEO also said that the company has 3 times more common equity tier 1 capital than in the financial crisis, which is really good. As I've been talking about in many of my previous videos, the Canadian banks were certainly prepared for the worst given their strong balance sheets. And if we take a quick look at the balance sheet for Bank of Nova Scotia, we find that they have $46.7 billion in cash and deposits at the end of 2019, while they paid out $4.3 billion in dividends. That simply means that even if the company doesn't make any earnings in 2020, which is unlikely, the company will still be able to easily sustain the dividend. So as a long-term investor, I really only see this discounted stock price as a buying opportunity. And right now, you can actually buy into this company's stock and get a secure dividend yield of 6.6%. Meanwhile, the company's actually been paying that dividend since 1832. In terms of a cash flow basis, I really see this as a strong company that I'm going to be buying into more, and I also see capital appreciation in the next 5 to 10 years. All right, guys, now getting into the second stock in my portfolio here, and this one pains me to show you guys because it is the worst investment that I've ever made, and that is Carnival Cruise Lines Corporation, ticker symbol CCL. All right, guys, so as you can see, I own 80 shares at an average cost of $39.45, bringing my total position cost to just over $3,000 US. Now, it's obvious to say that the stock price has tumbled dramatically over the past few months because of the current market conditions. And guys, if it weren't for this one stock in my portfolio, it'd actually be up in terms of US dollars, so whatever, it is what it is. So the current scenario with cruise lines is that they're obviously not operating and haven't been for the past few months, and on April 10th, the US government actually banned cruises from operating until mid-July. And this actually could be extended further depending on how long the country is in lockdown. Now, if we take a look at their balance sheet, we find that they have $2.9 billion in current assets assets while their current liabilities are $10.7 billion. And guys, this is absolutely atrocious for a company's balance sheet, and I do regret buying them for that reason. However, the good news is CCL has been arranging some deals to obtain $9.5 billion of liquidity, which should easily be enough to last them through 2020. And the hope is that the cruise line industry should resume in late 2020, if not early 2021, and that should reduce their cash burn and potentially increase their earnings again. Giving you guys my opinion on this company, I am confident that they are going to be able to make it through these current market issues, provided that it doesn't last for too much longer. And that is the reason why I'm still holding this company, but I'm not actually a buyer at this moment because I see too much risk relative to many of the other positions that I own in my portfolio. Alrighty guys, getting into stock number 3 here, and that is the Canadian National Railway with ticker symbol CNR.TO. And here you can see I own 15 shares at an average cost of $112.83 per share, bringing my total position cost to $1,692 Canadian. Now I am at about par on this position right now, with the current market price being $113, but I did average my position down to a pretty crazy cost basis in my other account that I will be showing you later. Now CNR is one of those companies that I'm extremely bullish on over the long term in my portfolio because they have been around for over 102 years now, and they also have tracks all across North America, giving themselves a huge moat. And on April 27th, they released their first quarter earnings for 2020, and in my opinion, it showed a lot of strength. Despite all of the current market issues they've been facing, alongside month-long illegal blockades on the tracks in Eastern Canada in February earlier this year, they actually maintained their revenues to be flat year over year at $3.5 billion. On top of that, they saw their EPS grow 31% year over year to $1.42 per share, which is absolutely insane. But this just simply shows the resilience of the business model, and when you get a company with a great moat like this, they're going to survive in all economic conditions. So as I mentioned, I did buy on the dip, which I will be showing you later, but for now, I'm not going to be buying any more since the share price has recovered back up to $113 a share. So CNR is a hold for me right now, but let's get into the fourth stock in my portfolio, and that is Facebook with ticker symbol FB. Alrighty guys, so in Facebook, I own 8 shares at an average cost of just about $180 per share US, with a total position cost of just over $1,400 US. And right now, we can see the share price has appreciated all the way up to $202 per share ever since their last earnings report, and that gives me a total return of just over 12% at the moment. Now, although Facebook did beat on the revenue and earnings in the last quarter, they are seeing a significant reduction in the demand for ads. And that makes sense because the first area that most companies are going to cut in rough economic conditions that we're experiencing is typically advertising. However, what we did see is that the company's fundamental growth metrics, like growing their user base, is actually improved dramatically in the past quarter. For instance, the monthly active users on only the Facebook platform alone increased 10% from a year ago, being 2.6 billion, which was definitely an effect of the lockdown, but still unbelievable that this company can grow so substantially, being that it's the largest social media company in the world. Not only that, but the Facebook family of daily active people, including all of their platforms like Facebook, WhatsApp, Instagram, and Messenger, the daily active users count is now at 2.36 billion. So guys, what this means is that when the current market issues are over and companies are more willing to spend more on advertising, Facebook is in a strong position for growth. Not only that, but the company is so secure in holding over $60 billion in cash and equivalents on their balance sheet right now, which should easily take them through these current market issues. So I don't want to get into too many of the details in this video, but let me know if you want a video where I analyze if Facebook is a good stock to buy in 2020 at the moment. Alrighty guys, getting into the fifth stock on the list here today, and that is Johnson & Johnson with ticker symbol J&J. Now, as you can see, I own 10 shares at an average cost of $129, and that gives me a total position cost of just over $1,289 US. Now, this company did actually fall just over 25% from its all-time highs in February because of the current market issues, but then soon recovered back up to $150 a share. Now guys, in my opinion, this is an excellent company and probably the most well diversified out of all of the companies that I do own in my portfolio. And as I've said in earlier videos, this is a company that's 134 years old at the moment and has been a dividend king and dividend aristocrat for many, many years. And in its most recent earnings report, J&J actually just increased their dividend by 6% just to reaffirm the financial strength of their business. And guys, we also saw that their earnings grew 9% year over year, along with some revenue growth. So overall, they're doing pretty solid at the moment and don't see a whole lot of hardships coming their way. Not to mention, Johnson & Johnson is one of the leading companies investing heavily in trying to find a cure for you-know-what, which does bring them tons of positive publicity along with potential revenues in the future, so that's a good thing. So overall, this is a company that's designed for really bad economic times, just like we're experiencing right now. But does that mean that I'm a buyer? Well, not at the moment, because I am quite a lot above my cost basis at the moment, but I would love to buy on another dip. But anyways, getting into stock number 6 here, and that is the McDonald's Corporation with ticker symbol McD. Now in McDonald's, you can see I own 8 shares at an average cost of just under $190 per share, giving my position cost of just over $1,500 US. And right now, the current market price is slightly below my average cost, but that's not a concern whatsoever to me because I see McDonald's as a great company to hold for the long term. As I've mentioned many times in my videos before, McDonald's to me is more of a real estate company than a burger flipping company. So although in their recent earnings report on April 30th, they said that their EPS dropped 15% year over year, it's not a concern for me whatsoever because I see the property values in this company appreciating significantly over time, along with their business model growing back up again. Now the company also stated that 75% of their restaurant chains across the world actually still remain open, and they are focusing more on drive-through and delivery services, which actually makes this business model a very sustainable one in a time like this. So it's important to realize that McDonald's is one of those companies that can remain profitable in essentially any economic environment. And it is also a dividend aristocrat, which makes it really good for dividend investors like myself, having paid and increased their dividend since 1976 when they first started paying it. So if the company does drop in price again, I will be happy to buy some more. All right, so getting into another Canadian bank stock that I own in my portfolio, that is the Royal Bank of Canada, of course, ticker symbol RY.TO. So as you can see, I own 50 shares at an average cost of just under $99 per share, bringing my total position cost to just over 4,900 Canadian. Now, just like Bank of Nova Scotia stock, I am down on RBC by about 14%, but this is not a concern whatsoever for me because they are in such a strong financial position. Taking a quick look at their balance sheet, we find that RBC has $64 billion in cash and due from banks at the end of 2019, while they paid out $6 billion in dividends, so that is really solid. So just like BNS, this company is so prepared for the worst, and I really can't see them cutting that dividend whatsoever. Even by taking a long-term look at their history of dividend payments, this basically confirms my claim, with RBC having paid their dividends since 1870. So as you can tell, I'm very bullish on this company, having bought just about $5,000 worth of shares, and I actually have been averaging down on my position in my next account, which I will be showing you. Alrighty, coming in with stock number 8 on the list here, another one that I've talked about a lot on my channel before, and that is Suncor Energy with ticker symbol SU.TO. Now in this account, I own 87 shares at an average cost per share of $31.76, bringing my total position cost to $2,700 Canadian. Now obviously Suncor stock has been tanking recently because of the oil price crisis, because they are the largest integrated oil and gas company over here in Canada. Now one of the main reasons why I bought this company in the first place is because of their diversification of operations, being in the upstream sector as well as the downstream sector. And that basically means that the business model is more sheltered when it comes to fluctuating oil prices, but obviously right now that's gone out of the window because they can't be sheltered in this environment. Now, if we take a look at their balance sheet, we find that Suncor has current assets of $9.9 billion and then current liabilities of $10.5 billion, which really isn't the best, but relatively good for an oil and gas company. On top of that, we find that Suncor has recently been able to increase their liquidity by $3.75 billion in the past few months alone, and that should allow them to stay afloat if they aren't able to make any earnings within 2020. So I'm almost certain Suncor will make it through the current market conditions, and even if they can't with this extra debt that they put on, the Canadian government would likely bail them out. But because of the larger risk in oil and gas right now and my heavy exposure into Suncor already, I'm not going to be buying the dip on Suncor. Alright guys, now the second last stock in my portfolio today is Visa with ticker symbol V. And I own 15 shares at an average cost of $145 per share, giving my total position cost to just over $2,100. Now Visa stock is up just over 20% in my portfolio, but I really don't see this as a huge gain, and I plan on holding them for the long term. Now you guys know my thoughts on Visa stock overall from the video that I posted above here. However, recently they actually put out their earnings report and actually beat on revenue and earnings estimates, which was a huge surprise. In the last 2 weeks of April, the company actually saw 100% growth in terms of online spending. However, they did see significant deterioration in the spending in other areas of their business. But with all of that being said, I am still of course bullish on this company, and I actually wish that I could buy more shares on the discount last month. So right now, Visa is a hold for me until I see some better prices. All right, now the last stock in my Quest trade portfolio is one that I'm debating whether or not I should sell, and that is ExxonMobil, ticker symbol XOM. Now I bought into this company a few months ago on a pretty good discount, I thought at the time, buying 25 shares at an average cost of $62 per share, bringing my total position cost to just over $1,500 US. But the current market price is just over $43 per share, and I'm down about 30% on this position, given the whole situation with oil and gas. Now I mentioned that this might be a company that I plan on selling in the near future here, and the reason is because of their recent earnings report. ExxonMobil posted a loss of 14 cents per share, or $610 million, in their recent earnings report, although analysts were expecting a positive result. Furthermore, if we take a look at their balance sheet, we find that their current assets are sitting at $50 billion, while their current liabilities are sitting at $64 billion. And although the company was able to receive additional financing of $12.1 billion to aid with the whole market issues, it's still going to be in a very tough position. In my opinion, if the company continues posting losses for the rest of 2020, they're going to need to seek additional financing or even sell some of their assets to actually stay afloat. And I do truly believe that because the company decided to continue paying its dividend, and that ends up being over $3 billion in cash every quarter. And this decision is really not in line with many of the other oil and gas players in the industry that have decided to cut their dividend to sustain their balance sheets. So I'm not so sure if I agree with the company's decision to keep that dividend, because I'd rather them have the cash to stay afloat. But maybe it just shows that management thinks they're confident they're going to be fine, so who knows. As for now, I'm extremely on edge with this company, and I'm not sure if I want to sell it and buy a better oil and gas player or something else with better opportunity. All right guys, so those were all of the stocks in my Quest trade portfolio, but I do have one ETF, and that is XUS.TO, which is the S&P 500 index ETF. Now this is very close to the Vanguard ETF VOO in the US, but you can actually buy XUS.TO on the Canadian Stock Exchange in Canadian dollars. And it is a Canadian dollar hedged version of the S&P 500, meaning that you're going to see those currency fluctuations. And I own 60 shares at an average cost of $49.24 per share, bringing my total position cost to just under 3,000 Canadian. And as you can see, I really haven't made any gains or losses on this position ever since I bought back in 2019, but it is a way that I'm diversifying my portfolio and buying into the market to hold for the long term. All right guys, so at this point in the video, I'm going to be going through my Wealthsimple Trade TFSA account that I have over here in Canada. And if you're wondering, I do have two accounts because the Quest Trade account can hold US dollars but actually has trading fees, whereas the Wealthsimple Trade account doesn't have trading fees, but it's only in Canadian dollars. So I like to have the Wealthsimple Trade account just to buy some Canadian stocks and not have to worry about trading fees. But anyways, getting into the first position in my portfolio, and that is Air Canada with ticker symbol AC.TO. And this one really isn't a big position whatsoever because I just started buying into it and really didn't have a whole lot of cash in my account, but I have 4 shares at an average cost of $19.20 per share, bringing my total position value just up to about $80. And as I've talked about in earlier videos, I do plan on adding a lot into Air Canada stock because I do see some very good value at the moment, and preferably below $18 a share. All right, now secondly, I own the Bank of Nova Scotia stock, ticker symbol BNS.TO, as you know, from my Quest Trade account. And I used this account to average my position down to 10 shares at an average cost of $51.69, bringing my total position value to just over $500. And right now I'm only up about 5% on this, but it was a good way to average my position down, and I do plan on buying into it further. Now the third stock in my Wealthsimple Trade account here is the Canadian National Railway, ticker symbol CNR.TO. And I was able to buy 5 shares at an average cost of $98 Canadian per share, which is an absolute steal in my opinion, and that brings my total position value of just over $500. So right now the return is sitting just over 15%, but really this was just a way to average my position down. I'm not going to be selling these anytime soon, and it just adds to my position in the company. Fourthly, I've got more shares in the Royal Bank of Canada, ticker symbol RY.TO, and so I averaged my position down by buying 15 shares at an average cost of $85.50 per share, bringing my total position value just over $1,200. And again, this was just a way to average my position down in the Royal Bank of Canada while building up my dividend passive income, because I think I got these shares at a yield just over 5%, 1%, which is pretty crazy for Royal Bank. Fifthly, I have some more Suncor shares that I actually bought before this whole market issue, and it really pains me, but I own 40 shares at an average cost of $38.13. And right now that position value is sitting at just about $1,000 and it's down about 36%. So as I talked about earlier, I'm probably not going to be adding to my position in Suncor because it is so heavy already. I'm just going to ride it out and hopefully make some of this money back in dividends and capital appreciation over time. And finally, the position that takes up about 60% of this entire portfolio. You're probably wondering, what the heck is this stock? Well, it's an ETF, and that is the Vanguard S&P 500 Index ETF. So I started buying into this one right at the peak of the bull market, and I was able to average my position down to 71 shares at an average cost of $73 per share. And that gives me a position value of just over 5,000 Canadian, which is a really sizable position in the S&P 500. But I think this is a great way to diversify my portfolio, and even if my individual stocks don't perform well, I know the S&P 500 will over the long term. So anyways, if you did stay this long, thank you so much for watching the video. I really do appreciate that. If you haven't already, make sure to smash that like button for the transparency in this video. And let me know down below what you think of these picks, if you're interested in any, if you own any, and then some of the stocks that you have in your portfolio. But anyways, if you haven't already, make sure to subscribe down below for more weekly videos just like this on investing, and I will see you guys in the next one.